In the world of investment and trading, Nasdaq has always emerged head and shoulders above all other exchanges, especially for retail traders looking for high growth opportunities. The potentials for disruption technologies redefining entire sectors, alongside with the possibility for exponential growth in share prices, have many people beginning their adventures here in order to become the titans of tomorrow. It's normal, therefore, to also see traders to begin navigating the exciting and yet volatile waters of Nasdaq in order to identify a precise way to capitalize on the defining enterprises of tomorrow. After all, this is one of the birthplaces of the modern economy, based on the connectivity, speed, and analysis using the tools and technologies of a new era. Amongst all the titles that may bring us wealth and prosperities lies Palantir, the data analytics firm based in Denver, Colorado. Palantir has been an enigmatic entity ever since it went public on the Nasdaq, with a reputation shrouded in controversies. It is a data aggregator and analysis platform. It has one of the deepest relationship pools in the street with public sector entities for large contracts in healthcare, defense, and intelligence analysis. Its price action is directly linked with the company's own fundamentals and risk appetite, and with an increasing institutional participation in the company, there may be a lot more potentials going forward. Before the video continues, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. In recent market movements, Palantir has settled at the $16.39 level, exhibiting a marginal decline around 0.5% in the past 5 days and a more substantial downturn of 8% over the preceding month. While these brief market shifts may not carry significant weights in the grand scheme of things, various factors beyond the fundamentals may contribute to those fluctuations. Investor sentiment towards Palantir remains optimistic, acknowledging that it is a standout company with cutting-edge tech, essential to business around the world, particularly within the public sector. It is, however, a notable concern as well, because the issue stems from the fact that Palantir has considerable dependence on the public sector, resulting in a somewhat top-heavy and less diversified stakeholder structure. Despite being a well-known aspect of Palantir's business model, this dynamic likely plays a role in shaping its current valuation. As we project into the upcoming year, potential challenges may emerge from the broader market. Given that Palantir's clients primarily operate in the real economy, potential budget cuts for research and analysis could be challenging, with sales expected to either plateau or to decrease. Nonetheless, Palantir has demonstrated prowess not only in generating profits and maintaining a self-sufficient cash flow, but also in navigating evolving trends like artificial intelligence and large language models. Beyond purely economic motivations, Palantir's origins and ethos extend into serving entities too sensitive for engagement by purely commercial partners, providing it with a distinct competitive edge. While the fundamental profitability of those ventures remain uncertain, Palantir undoubtedly gained traction in the market throughout 2023. As we navigate the dynamic landscape in 2024, close attention should be paid to how Palantir adapts and capitalizes on emerging trends, making it a compelling entity to watch in an ever-evolving market. With that being said, here are the technicals. The trading volume of Palantir has recently been around 31 million shares, compared to the average volume of 41 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $21.85. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is too thin, it would be easy to influence the stock price, but low liquidity could mean that the demand is limited. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is too large. For instance, In a breakthrough scenario, the volume would be significantly higher than the average one. The market cap is currently around $36 billion compared to the enterprise value of around $15 billion. As we compare the current price to the historical price fluctuations, the stock is 5% higher than the 1-month low, 13% higher than the 90 days low, and 181% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment and where the stock is likely going to head next, the implied volatility is around 70% compared to a historical volatility of 44%. The put-call volume ratio is currently at around 66%. It is normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors will hedge their long positions by buying put options. The most recent volume of options traded is 174,000 contracts a day compared to the 30-day average of 243,000. In terms of open interest, the most recent volume of open interest is 3.3 million contracts compared to the 30-day average of 3.1 million contracts. In terms of the shareholder structure, institutional shareholders own 40% of the total float. The biggest shareholders include Vanguard, Renaissance, and BlackRock. Usually, it's always encouraging to see participation from institutions when holding a stock long-term, because it offers a layer of stability and a token of reliability in the medium to long run. It means that the market is confident that this will deliver value in the long term, which is a very important factor to consider for investors. I would personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there are many exceptions to this rule, as there will always be great companies mostly owned by retail traders. The current short interest is about 6% of the total float, 53% of which from the dark pools. Typically, if the short interest is above 15%, there would be arguments for a short squeeze. That's not the case for Palantir at the moment, since the short interest is. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one, the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. In conclusion, I maintain the perspective that Palantir will remain as a substantial player in the years ahead, even at the face of current unpredictable swings in its stock prompted by unforeseen circumstances. It appears careful and cautious to slowly build up a position over time, giving little heed to the transient fluctuations in its prices. This strategy would assumes that the portfolio aligns with the appropriate risk tolerance for tech and how can I put it? Yeah, for tech stocks. I would recommend a commit between 3 to 5% of your portfolio in Palantir overall and to split the allocation in batches of 20% over time.